Today's video was inspired by a video which I watched recently by Trading Championship winner Kevin Davey. In his video, he demonstrated a simple strategy which works on crude oil. And I thought I'd take the same strategy and the same code and apply it to the Forex markets to see if I can find something that works equally as well. And I'm pleased to say that I did find a strategy which is usable for Australian dollar versus the US dollar. I've mentioned Kevin in a few of my previous videos, and I often recommend this great little book for traders who are looking for new strategy ideas and also looking to improve their skills on coding, easy language or power language like I use in Multicharts. But if you are new to Kevin, then I highly recommend you check out his YouTube channel, check out his videos, and I'll leave a link to his channel down in the description of this video. The strategy idea is simple, and as we know, simple often works best. We're looking for momentum, so we're looking for longer term momentum, so let's say a longer term uptrend, and then we're looking for a shorter term pullback within that longer term trend. Once we have identified that shorter term pullback, then we buy and enter long, and we do the opposite for short selling. We're using a simple fixed pip stop loss or fixed dollar stop loss, and we're also using a fixed dollar profit target, which is going to be fixed at 1.5 times the value of the stop loss. So if we've got a stop loss at 2,000 or maybe 200 pips, then our profit target is going to be 3,000 or 300 pips. Kevin found that in crude oil, using the values of 40 and 10 for what I'm going to call the look back period, and a $3,500 stop loss worked best. We're using daily bars, so for a long trade, we want to see the most recent close higher than the close of the last 40 bars or the last 40 days, but we also want to see that close lower than the close of 10 bars ago or 10 days ago. So there are our inputs, 40 and 10. And to go short, it's the opposite. We want to see the close less than it was 40 bars ago, and we also want to see the close higher than it was 10 days ago. So we've got that longer term trend and then a slight pullback, and then we enter at market on the next bar. 40 and 10 with a $3,500 stop loss might not work on Australian dollar, US dollar that we're going to use, but I'm going to test that and find what does work. As Kevin did, I've also used some in-sample and some out-of-sample data for this test. The first set of data I'm going to use is from 2008 through to the end of 2015. So that first 8 years. We're going to look at that and look for a decent look back period and a decent stop loss. Once I'm happy, I'm going to test it on an extra further 2 years, so 2017 and 2016. And then if it's still working nicely, I'm going to check it on the rest of the data which I have, which is from 2018 through to the present, which is about August, September 2021. If the strategy is robust and I've done my job properly, then it should continue to work into that out of sample data. So let's go over to the computer where firstly I'll show you the code and then we'll have a look at the development stages. Let's have a look at the code first then, and you'll see I've got some notes here. Idea taken from Kevin Davey's video on crude oil Algo, and we're going to use a daily chart. I've got a couple of inputs. I've called it my bars back and stop, which is the stop loss. So very easy, we've got a momentum entry, and we're saying if the current close is greater than the close my bars back ago, so at the moment this is 40, so if the close is greater than the close of 40 days ago, which is suggesting that we're in some sort of a longer term uptrend, and the close is less than the close my bars back divided by 4, so in this case divided by 4 will be 10, so the close is greater than it was 40 bars ago, so we're in a longer term uptrend, but it has just pulled back a bit, come down, and it's less than the close of 10 bars ago. Then we want to buy next bar at market, and the opposite is for short trades. We've got a stop loss which we're going to test, and then we've got a profit target, and I've mentioned the profit target is going to be 1.5 times the size of whatever stop loss we use. So let's go and apply this signal to a chart and see how it works. Like I mentioned earlier, at the moment I'm going to use data from 2008 to the end of 2015, and also want to mention now that I'm using $50 worth of trading costs. We're going to be testing on one full lot of Australian dollar, US dollar, So $50 is equivalent to 5 pips of trading costs. So the first thing I wanted to do was test that look back period. And this is our look back, or my bars back as I've called it. And I've tested from 20 bars right the way back to 52 bars. And I've gone in steps of 4. The reason I've gone in steps of 4 is because I wanted to start with numbers that were divisible by 4. You remember the shorter term my bars back, or the shorter term look back, is only 1/4 of the longer term. So if we've got a longer term of 20, then that shorter term is going to be equivalent to 5. Okay. Now the first thing to note is that they're all making money. That's great. That suggests some sort of robustness. The best value in terms of net profit and in terms of average trade is at 28. So the longer term is going to be 28. The shorter term will be 28 divided by 4, or 7. However, I don't want to pick just the best values in this study. So what I'm going to do is I'm actually going to pick just the middle value, because 36 bars back and we've got a net profit of 52, we've got 44.66 lower than that, and we've got 36.45 above it. So I'm just going to pick somewhere in the middle at 36. So I have 36 applied to this chart. So let's have a look at the equity curve. And there's the equity curve, which is not a bad equity curve at all. So the next thing I want to do is look at that stop loss value. And you've guessed it, I've done an optimization. And I've optimized from 100 pips right the way through to 600 pips. And I've gone in steps of 50 pips. Now, looking down the net profit, the best value we've got is at 450 pips. We've got fewer trades, we've got 68 trades. Obviously, the larger the stop loss, the larger the profit target as well, because remember, the profit target is a multiple of the stop loss. So a stop loss of 500 pips, we'd have a profit target of 1.5 times that, or 750 pips. So we've got fewer trades as that stop loss and the profit target gets larger. I tend to like to keep as many trades as we can. I found that sometimes that helps the strategy robustness, tends to not over-optimize too much. So if we look at values of 500 pips, for example, we're making 56,000 net profit. However, if we look at a value of half that, at 250, we're not making half the profit, we're making more than half the profit. So if you're using position sizing based on your stop loss, like I sometimes do, then your R values are going to be higher using the smaller 250 pip stop loss. 250 pips is not the best, but it is in a stable area. So for now, I'm going to use 250, but bearing in mind that a larger 450 is best, but they're all making money, so that's really good. So there's the equity curve using 250 pips. Unfortunately, there is a bit of a flat period in the middle of this data here, which is slightly annoying, but we're not looking to make the best equity curve in this particular study. So let's carry on with 250 pips for now. So now we've got our look back period, or our my bars back, and we've got our stop loss. Let's apply some more data. Let's look at some out of sample data. So in this workspace, we've got data up until the end of December 2017, so an additional 2 years worth of data. And hopefully we see some new highs in the equity. And I think we just about have seen new highs. It's a little bit flat, but looking, indicated by the green dots, we are making new highs. So I'm happy to carry on. But there's not too much more that I do want to optimize with this strategy. The next thing I do want to do is look at that extra out of sample data. I want to look at some more out of sample data from 2018 through to September 2021 to see if it has continued to perform and make some money. But before we do that, if you're enjoying this video, then please give it a thumbs up. In this fourth workspace then, we've got the data up until 10th of September 2021. Looking at the equity curve again, look, we are making new highs up to very recently. So that's quite pleasing. And even that flat period here, it looks a little insignificant in comparison to the overall uptrend. So I'm actually quite happy with that. Net profit, we're making $47,500. One last thing that I do want to check is, remember that best stop loss value was 450 pips. So in this workspace, I've got the full data set right up until September 2021, but I've changed the stop loss to 450 pips. And you can see that even that is still making new highs. We haven't got that flat period here. It's a slightly flatter through here, but we've got a better uptrending period here, but we are obviously making new highs. In terms of net profit, we've got 75,000. Remember, with the smaller stop loss, it was only 47,000. But I expect most of those stop loss values would work, which does suggest some sort of robustness in this strategy, which is exactly what we want. So just before we conclude with this video, I want to add a couple of developments which I wasn't originally going to include in the video. I'm going to show you the results from some walk forward analysis that I've carried out. I don't often show the way that I use walk forward analysis, but I thought it was appropriate for this strategy, as I know Kevin also likes to use walk forward analysis too. And for this study, I've done it manually rather than using Multicharts' built-in walk forward analysis feature. Looking at this spreadsheet, we can see the columns are split into years from the start of the data, which was 2008, all the way through to 2021. Now, for my walk forward analysis, I've used blocks of 4 years. So for the first block, I've used 2008, 9, 10 and 11. I've optimized to find the best bars back, which is the input or the look back period, and the best stop loss. And then I've recorded it. So for 2012, I shall enter 44 and 450 pips for the stop loss. Then I've moved forward a year, so we're going from 2009, 10, 11, 12, and then with optimization found the best bars back and stop loss for that 4-year period and recorded it here. And then what we've done, we've built up these blue boxes which we will then apply to the year 2012, 13, etc., all the way to 2021, and they'll be applied to unseen or out of sample data. So that's going to build us an equity curve showing the results of the strategy optimizing for the previous 4 years. We can only start the study from 2012 because that's the first year that we have the optimized results. So we can't use from 2008. We have to start at 2012 and we can go right through to 2021. So we're going to have two comparisons. We're going to have a strategy where I've used the walk forward inputs, and then I'm going to compare it to the strategy that you've already seen, but only going back to 2012. So we're going to get a decent comparison between the two. So let's go back to Multicharts and look at that now. So in this first workspace we're going to look at, we've got data from the 1st of January 2012 until about September 2021. And the strategy inputs that we've used are the best ones that I came up with from the normal analysis. So we're using, for my bars back, 36 and the 250 pip stop loss. So looking at the results, there's the equity curve, which is part of the equity curve that you've already seen. We're making $28.6 thousand net profit. Now let's look at the walk forward analysis equity curve. So in this workspace, we've got exactly the same date range from 2012 through till September 2021. However, for each year, we've used a different stop loss and bars back input. Sometimes it will be the same as the previous year, sometimes it will be different because we've found them by optimizing the prior 4 years. So the results that we're going to see for each year are not going to be optimized specifically for that year, but optimized for the 4 years prior to that year. So let's look at the results. Now we're making $32.6 thousand. That's interesting. We're actually making $4,000 more using the out of sample data than we did using the strategy that I'd previously created. And there's the equity curve. It's got a horrible period through here. It's not very smooth, but it's certainly trending up. And we can see by the green dots, we are making new highs. So that's really interesting. It's quite a nice result from this 9.5 years, which were built from out of sample data. So the fact that this is actually making more money than the previously optimized version suggests some sort of stability or some sort of robustness of this strategy applied to this market. I did test all the other major Forex pairs using this strategy as well, but I found Australian dollar versus the US dollar to be the most robust. As always, I won't be trading this strategy straight away. I shall continue to watch it for another few months to see how it performs, see if it continues to make new highs, and then and only then will I consider adding it to my own portfolio of live trading strategies. I hope you've enjoyed this study today and this video, and thanks to Kevin for his idea and even the code. If you want to see his video, his original video on the crude oil, I'll leave a link to that in the description down below, so go and take a look at that. Anyway, that's all for this video, so until the next one, this is Jared Goodwin, and thank you.